What if I told you that the most exciting uh, high-margin software and quantum tech stock of the decade, it isn't some secretive Silicon Valley startup operating out of a garage somewhere?
Right.
What if instead it is a 115-year-old company that honestly most people still think of as a dinosaur? Today, we are taking a deep dive into IBM's massive strategic evolution.
It's just a fascinating transformation to watch unfold. We're talking about a company that has actively shed its reputation as this, legacy hardware provider to emerge as a highly efficient hybrid cloud and quantum computing powerhouse.
Yeah, and to figure out if this pivot is real or just like really good marketing, we aren't just looking at PR spin today.
Definitely not.
We've actually pulled together a stack of their hard financial performance metrics, technical market data, sentiment analysis from the options market, and their internal strategic tech roadmaps.
Which is a lot to get through.
It is. But our mission today is to help you unpack whether IBM's multi-billion-dollar bet is actually working, what the big institutional money is signaling, and how the impending quantum computing revolution actually factors into your long-term wealth building.
Exactly.
So, welcome. Whether you are actively holding tech stocks or you're just, insanely curious about how a massive giant reinvents itself, we are laying out a grounded, forward-looking analysis of a familiar tech giant that has quietly flipped the script.
Yeah, because the narrative of a new IBM is definitely loud right now. But as always, we really have to look past the hype and examine the actual mechanics of the business itself.
Right. Let's start with the hard numbers. Everything IBM wants to do in the future requires a massive cash engine to fund it today.
Always comes back to cash flow.
Exactly. And looking at full year 2025, IBM's revenue hit $67.5 billion. That is a 7.6% year-over-year growth. But the number that really caught my attention was their free cash flow. It's set at $14.7 billion, which is a 22% margin.
Yeah, and that 22% margin is the absolute linchpin to understanding their current strategy. I mean, when people think of legacy IBM, they usually think of physical hardware, right?
Mainframe computers, physical servers, that kind of.
Exactly. And when you sell hardware, your margins are constantly compressed by, supply chain costs, manufacturing delays, shipping logistics.
It's expensive to move heavy metal around.
Right. But a 22% free cash flow margin, that is the kind of metric you expect from a pure play, modern SaaS company, software as a service.
Because software is infinitely scalable.
Precisely. It is the exact opposite of hardware. Once you build a software platform, every additional customer you onboard is almost pure profit because you aren't manufacturing a new physical product for them.
Right.
So that 22% margin tells us that their core operation is incredibly efficient at converting sales into actual usable cash.
And this wasn't just a one-off blip for 2025 either. The momentum carried right into Q1 2026. Revenue rose 9% to $15.9 billion. And their adjusted earnings per share actually beat expectations, coming in at $1.91 versus the $1.81 that Wall Street was expecting.
And if you dig into it, the software division is clearly the star of the show here.
Yeah, it grew 11% with a 37.7% margin, which is wild.
It is. If we look at their overall financial health, they pulled in $2.2 billion in Q1 free cash flow alone. That's up 13% year over year.
Wow.
And they are generating 15.6% net margins on nearly $69 billion in trailing 12-month revenue, meaning, the total revenue calculated over the past 4 consecutive quarters.
They're also paying a really healthy 2.9% dividend yield while they do all of this, which is nice for investors.
It is.
And management is seemingly so confident that they've reaffirmed their 2026 guidance, projected above 5% constant currency revenue growth, and another $1 billion in free cash flow improvement.
I should probably clarify constant currency for a second, just because it's a metric companies use that can sometimes obscure reality.
Yeah. Please do.
So because IBM operates globally, they take in revenue in euros, yen, pounds, and so on. If the US dollar happens to be very strong, those foreign revenues look smaller when they convert them back to report earnings.
Right. It artificially deflates the number.
Exactly. So constant currency strips out those exchange rate fluctuations to show you the real underlying growth of the business. So a 5% growth rate, ignoring the noise of the currency markets, that shows genuine operational expansion.
I appreciate that clarification. And here's where I want to push back a little bit on this whole software narrative.
Okay, let's hear it.
I see in the financial roadmap that they just closed an $11 billion acquisition of a company called Confluent in March of 2026.
They did.
So are they just buying their revenue growth? I mean, $11 billion is a massive check to write just to boost your software division. Is this actually an impenetrable competitive moat they're building, or just a really expensive Band-Aid to keep the gross numbers looking good for Wall Street?
That is a very healthy skepticism. And to answer that, we have to look at how Confluent actually fits into the machinery IBM already owns, specifically a platform called Red Hat OpenShift.
Okay.
What IBM is trying to build is a fortress of extremely high switching costs.
Explain the mechanism there. I mean, switching software is always a headache for companies, sure, but it doesn't necessarily justify an $11 billion price tag.
Let's visualize a modern enterprise. Okay, say a massive global bank. Imagine it as a sprawling, bustling city.
Okay, a city.
Red Hat OpenShift is essentially the foundational grid. It's the roads, the zoning laws. It allows that bank to build and run their applications absolutely anywhere, whether that is on a public cloud, a private server in their basement, or a hybrid of both.
Okay, so OpenShift is the foundational city grid. Got it.
Right. Now, Confluent, which is built on advanced data streaming technology, is the city's high-speed underground subway system. It manages the real-time flow of massive amounts of data between all those applications across the city. When IBM integrates Confluent seamlessly into Red Hat OpenShift, they own both the roads and the high-speed transit, moving millions of data points instantly.
I see where you're going with this. So if a bank decides they want to leave IBM for a competitor, they aren't just canceling, like, a basic software subscription.
No, they're essentially trying to tear up the foundational roads and the entire subway system while the city is still operating at rush hour.
That sounds impossible.
It is a logistical nightmare. The pain of migrating away from a tightly integrated hybrid cloud stack like that is just astronomical.
Right.
Chief technology officers simply won't do it because the risk of crashing their own company's entire data flow is way too high. That is what creates incredibly sticky, high-margin recurring revenue.
So IBM didn't just buy a company to boost their quarterly numbers. They bought the transit system for enterprise data.
Exactly.
So you get locked into the ecosystem, and IBM just collects the rent. It's brilliant.
It really is.
But if this software fortress is generating all this excess cash, the natural question is, where is that cash actually going?
And that transitions us perfectly from the software cash engine into their future bets, because they are pouring this money straight into the quantum computing frontier.
Yeah, we're talking about a completely different paradigm of computing here, and IBM is aggressively trying to build an unmatched moat in this space, too.
Yeah, when we look at the landscape of quantum computing today, IBM's lead is highly tangible. I mean, they currently have over 340 organizations running real workloads on their quantum systems right now.
Wow.
And since 2017, they have signed over $1.1 billion in quantum contracts.
And the U.S. government is clearly invested in this timeline, too. I mean,
Yeah.
There was a massive $1 billion CHITS Act grant awarded specifically for a quantum foundry.
Yes.
But what's crazy is IBM didn't just take the government money and absorb it into their massive corporate structure.
Right, they matched it.
Yeah. They matched that grant with $1 billion of their own capital to form a spin-out entity called Andron. So that's $2 billion focused purely on a quantum foundry.
And this move is generating intense speculative chatter on Wall Street. You have this legacy company that suddenly carves out its most futuristic, cutting-edge technology arm into a separate entity.
Well, the rumors are flying that Andron might eventually go public as an independent company. Market analysts are actually comparing it to VMware's historical trajectory. Can you kind of break down why that comparison matters for our listeners?
Sure. So think back to the relationship between EMC and VMware. EMC was a massive data storage company, and they owned VMware, which was pioneering cloud computing virtualization.
Okay.
For a long time, the stock market valued EMC purely based on its boring legacy storage business, largely ignoring the absolute goldmine of VMware inside of it.
Oh, interesting.
Yeah, so when VMware was finally spun out and went public, it unlocked a massive amount of hidden value. The market suddenly priced VMware as a high-growth tech star, completely independent of the legacy storage stuff.
So if we apply that to IBM right now, the market looks at IBM and prices it as a hybrid cloud software company.
Right.
But if Andron goes public, Suddenly, investors have access to a pure-play, state-backed quantum computing titan that IBM still holds a massive financial stake in.
Exactly. It creates a fascinating dynamic for shareholders. And the timeline for this technology actually maturing isn't as far off as people assume either.
Really?
Yeah, the IBM Quantum Sterling roadmap is aggressively targeting what they call quantum advantage by the end of 2026.
Let me stop you there for a second because quantum advantage sounds a lot like marketing speak.
Fair enough.
What does that physically mean in the computing world?
Quantum advantage is a very specific, measurable threshold.
Okay.
Is the point where a quantum computer can solve a practical, real-world problem faster, cheaper, or more efficiently than the most powerful traditional supercomputer in existence.
Oh, wow.
Yeah, it is the exact moment quantum stops being an academic science project and becomes a commercial necessity.
Knowing that this 2026 threshold is approaching, I have to draw an analogy to another tech giant.
Go for it.
Looking at IBM's strategy, it really feels like they are running NVIDIA's playbook. NVIDIA didn't just design the physical AI chips. Years ago, they built the software foundation called CUDA. So developers were locked into programming in their specific ecosystem long before AI hardware went mainstream.
That is a brilliant comparison.
IBM seems to be building the foundational software tools and developer ecosystem for quantum right now, while the hardware is still in its infancy.
That comparison holds a ton of weight. By getting those 340 organizations using IBM's quantum software tools today on early-stage hardware, they are essentially training an entire generation of quantum programmers in the IBM dialect.
So when the quantum hardware finally scales up and achieves that advantage we talked about, those companies don't have to rewrite millions of lines of code.
Nope. They just keep using the IBM software they already know, and suddenly their algorithms are running exponentially faster.
Which creates immense optionality for IBM.
Yeah.
I mean, building the software ecosystem now opens the door for massive unannounced partnerships down the line. When you dictate how developers interact with the machine, you basically own the future of the technology.
Exactly.
So we got this cash printing software business acting as the robust foundation today, and this incredibly ambitious, fully funded quantum roadmap acting as the massive upside for tomorrow.
Yep.
If IBM has built this inescapable software fortress that funds a quantum moonshot, Wall Street really shouldn't be ignoring it. Let's look at how institutional money and market sentiment are actually pricing in these moves.
Well, the price action has definitely been a roller coaster. Following the news of the SheetGPS Act grant for the Quantum Foundry, the stock saw a massive 12% rally, hitting a new high in June.
Go.
But shortly after, it got caught up in a broader market pullback and dropped 22%. Right now, the stock is consolidating around the $249 level.
Right. And for a general audience, when technical analysts talk about consolidation, they basically mean the stock has stopped falling and buyers are essentially putting a safety net under the price, betting that the momentum is poised to break upward rather than crash further.
Right.
But what I am really zeroed in on is the options activity. Following that Quantum Foundry announcement, traders executed nearly 200,000 options contracts.
That is a staggering number.
It is. That is 15 times the 30-day daily average. Retail day traders do not coordinate a 15-time spike in volume. That is heavy institutional capital taking positions.
Oh, absolutely.
So I have to ask, is Wall Street positioning for a massive upside surprise on their next earnings call, or do they know something we don't about this Anderon spinout?
Well, we obviously can't verify if anyone has inside information on an Anderon IPO.
Sure.
But what that massive spike in options volume tells us is that the institutional market clearly sees a quality plus optionality profile here.
Define that dynamic for the listener. What makes a stock quality plus optionality?
Okay, so quality means the core day-to-day business is incredibly safe. The 22% free cash flow margin we discussed earlier, the reliable dividend, the sticky Confluent and Red Hat ecosystem where clients can't easily leave, that is the quality.
Right, the safe bet.
The optionality is the immense, almost unquantifiable upside of quantum computing. It's like getting a free lottery ticket attached to a stable blue chip stock.
Oh, that makes sense.
So when the stock drops 22% during a broader market panic, institutional money looks at that consolidation around $249 and sees a rare opportunity to buy the dip with a very favorable risk-reward setup.
And the broader analyst sentiment really backs up that bullishness. Barclays just initiated coverage at an overweight rating with a $350 price target, and their ultimate bull case goes all the way up to $449.
Which is huge.
It is. Bank of America maintains a buy with a $300 target. Wedbush raised its target to $350 as well. But I found a specific note from Wedbush pretty fascinating.
What did they say?
They pointed out that earlier fears of AI disrupting IBM's legacy COBOL install base have, in their words, largely dissipated.
Ah, yes. That is a crucial narrative shift that a lot of casual observers completely missed over the last year.
Can you break that down? Because I imagine a lot of people don't even know what COBOL is.
Sure. So COBOL is an ancient programming language developed in the late 1950s.
Very ancient.
Very. But the catch is that an estimated 80% of the world's daily financial transactions, banking systems, ATMs, corporate payrolls, they still run on mainframes using COBOL.
That's terrifying, honestly.
It is. And for a while, the market narrative was that new AI coding assistants would instantly rewrite all that ancient code into modern languages.
Which would effectively eliminate a massive chunk of IBM's legacy consulting and mainframe business practically overnight.
Exactly. That was the huge fear.
But that mass extinction event didn't actually happen.
No, it didn't.
Instead of hiding from the AI revolution, IBM leaned into it. We're seeing major public partnerships like the one at Wimbledon, where IBM showcased new AI-powered fan experiences and data analysis using their WattSense AI platform.
Yeah, they took the very technology that was supposed to destroy their legacy business and they embedded it directly into their own stack.
Brilliant.
They are using their WatsonX platform to manage the AI transition for their massive enterprise clients. They aren't letting an outside startup come in and rewrite the bank's code. IBM is using its own AI to manage the bank's infrastructure modernization.
So they turned a massive existential risk into a new recurring revenue stream.
Exactly.
It is brilliant defensive maneuvering.
Yeah.
But, as much as I love a good corporate comeback story, every bullish thesis needs a stress test.
Always.
No stock is immune to gravity or market mechanics. What are the immediate hurdles and risks that could fracture this momentum?
Well, the most imminent hurdle is right around the corner. We have the Q2 earnings call scheduled for July 22, 2026. The market isn't just going to look at top-line revenue. They are specifically demanding confirmation of greater than 10% software growth.
Because Wall Street needs immediate validation for that $11 billion Confluent acquisition and the massive investments in the Watson engine.
Exactly. If they spend all that money and the software growth comes in sluggish, say, 5 or 6%, investors are going to panic.
Which brings us to the first major risk, right? AI hesitation.
Yes. Over the last 2 years, we've seen an incredible rush by companies to buy AI capabilities. But there's a growing fear that enterprise buyers, the chief technology officers and chief information officers, they might freeze their large AI and hybrid cloud deployments just to digest the technology they've already purchased.
A sort of technological indigestion.
That's a great way to put it. If that enterprise buying cycle pauses, Q2 software growth could easily slip to the mid-single digits.
And if they miss that 10% threshold on July 22nd, it instantly validates the fear that drove that 22% drop in June, and the stock could be severely punished. I want to focus on risk 2, though, which I think is even more consequential for the long-term thesis. Quantum delays.
This is a big one.
The IBM Quantum Starling roadmap targets quantum advantage by 2026, but their goal for fault-tolerant quantum computing is currently targeted for 2029.
Right.
I have to admit some deep skepticism here. 3 years is an eternity in the tech world. Waiting until 2029 feels like a lifetime. Are we literally pricing in perfection a decade out?
It's a highly valid critique. The speculative premium currently baked into IBM's stock relies entirely on them hitting those complex milestones perfectly.
Before we talk about the timeline risk, explain what fault-tolerant actually means in this context.
Okay, so quantum bits, or qubits, are incredibly fragile.
Right.
They operate at temperatures colder than deep space, and the slightest interference, a stray photon, a microscopic change in temperature, causes them to lose their quantum state, which creates massive computational errors.
So they break easily.
Very easily. Fault-tolerant means building a system with enough advanced error correction that the computer can reliably solve incredibly complex, long-running calculations without those environmental disruptions destroying the math. It is literally the holy grail of quantum mechanics.
So if they don't hit the advantage milestone in 2026, the market is going to completely abandon faith that they can achieve the fault-tolerant holy grail in 2029.
Exactly. If they fail to demonstrate practical quantum advantage by the end of 2026, the 2029 timeline becomes a fantasy in the eyes of Wall Street, and the stock will instantly compress as that speculative premium evaporates.
Wow. So what does this all mean for the structural strategy of the company? It sounds like they are walking a very precarious tightrope here.
They really are. If we connect all the pieces back to the financials we started with, the entire investment thesis relies entirely on the high-margin software business acting as a safety net.
Okay.
The software revenue is funding the quantum timeline. It's paying for the deep tech research, the foundries, and the massive capital match for the Anderon spinout.
So if the software growth stumbles on that July 22 earnings call, the safety net vanishes.
And if the cash flow safety net vanishes, the market will no longer give them the benefit of the doubt on a highly speculative 2029 quantum target.
It is a remarkable high-wire act. Everything hinges on software execution in the immediate term, just to buy the financial runway for the quantum revolution in the long term.
Yep.
Okay, pulling all these threads together, from the 22% cash flow margins to the Confluent integration, the Anderon spinout, and the technical risks, what is the final verdict on IBM's great pivot?
Well, based on the profound structural transformation of their balance sheet, the sticky enterprise moat they've built with Red Hat and Confluent, and the immense optionality of their quantum investments, the analysis yields an 8 out of 10 bullish score.
An 8 out of 10. That's a very strong conviction rating given the execution risks we just discussed.
It is. The setup ultimately presents as a multi-year hold, though. You aren't buying this just for a quick pop on the July earnings, although the technical consolidation shows that is certainly possible. You are holding this for the convergence of two massive compounding trends: the high-margin hybrid cloud integration happening today and the impending realization of commercial quantum computing tomorrow.
It really is a masterclass in reinventing a legacy brand, moving from a sluggish hardware manufacturer to a high-margin software fortress funding the next era of human computing.
It's impressive.
But as we wrap up this deep dive, I want to leave you with a provocative thought to ponder. Something that builds on this timeline, but takes the implications one step further.
Ooh, I like where this is going.
If IBM actually achieves fault-tolerant quantum computing by 2029, what happens to global cybersecurity? Traditional encryption, the complex math that protects every single bank account, every national security database, every private text message, it relies on equations that would take current supercomputers thousands of years to crack.
Right, but a quantum computer.
A fault-tolerant quantum computer could theoretically crack those same equations in hours. So if IBM holds the foundational patents and the developer ecosystem for that technology, is the market fundamentally underpricing the immense intellectual property they're accumulating right now?
That's a massive question.
Are we looking at a company that isn't just a successful tech business, but is quietly positioning itself to become a mandatory cornerstone of global security? Think about that the next time someone tries to tell you IBM is just a legacy dinosaur.